Hello everyone, Craig Rice here. I wanted to go ahead and get you some information and really important information about what's going on in the real estate industry. This information is very important to know and understand because they're changing the whole game when it comes to credit reporting. Fannie Mae and Freddie no longer using a tri-merge. They're going to use a bi-merge, which means you could choose between two credit bureaus and only need two credit bureaus, but also included is going to be VantageScore 4.0. Yes, VantageScore 3.0 is Credit Karma. The new one, or newer, most recent, is VantageScore 4.0. It's a predictive credit scoring model. So what also is going to be included in the decision making of Fannie and Freddie will be FICO 10 and FICO10T. What does T mean? It means trended data. So it's going to take the last 24 months payment history on all accounts. And it's going to, especially on revolving or credit cards, it's going to average out over the course of the last 24 months. It is going to average out what your average balance would be over the course of 24 months, or the most data up to 24 months that they have. What does that mean? A few different things, but let me kind of go back before getting into that. Why are they doing this? Over 20 years, we'd have FICO 2, 4, and 5. Equifax, Experian, TransUnion, the mortgage scores. Then you got the credit card scores and the auto industry scores, all different scores. This is being done to lower the risk of mortgage default. And with these other models, they're going to be able to predict that risk in the future. So let me get you a little more information here about me. Who am I? You know, you know, they call me Credit Craig in the industry. I've been doing this since 1996. Okay, so in 1996, I really started in the insurance industry. A lot of people know some of this stuff, but most or a lot do not. So in 1996, the company I was doing insurance with, and I was 18 years old, was moved into not just doing insurance, but providing mortgage products or services for their clients. I quickly got into that. I loved it. I have mortgage, running through my blood. So I've been doing this a long time, and quickly that year I started seeing that clients had credit problems. When I was 15 years old, I worked in a law firm. It was a consumer financial protection law firm, and I learned in my summers going to, I believe it was a 23rd or 26th floor at the Daily Center in Chicago, and learning Consumer Protection Act. So somehow that combined in with what I was doing, and it quickly blew up. Many loan officers from other companies were immediately taking action and sending me files. For my direct clients, I was getting the files done or getting that done to increase the credit scores at no cost to my clients. Later on down the road, and I'll kind of get through this, I had to start charging because it was costing me, a nice penny to get this done. 2008, subprime market collapse at the end of 7 and beginning of 08. I had my 031 licensed loan originator with the Office of Banks and Real Estate. I had my insurance producer's license. I was fixing credit. Throughout my course of my career, I've had a total of 3 credit repair companies, 2 in which I sold off as profits. The first one wasn't planned to do that, but then I ended up seeing that I could do that, repeat that process, make a nice amount of money, and then keep this last one that I've had open for many years now. So that's a little bit about me. I've opened up several offices. Miami, Los Angeles, Chicago, Rockford, opening up another one here in Tampa where I'm at right now, and continuing to build. We have, hundreds of thousands of loan officers that send us files. Not everyone's active because some are not, doing well in their own side when it comes to the mortgage industry, and that's a big reason why I do these things, to help educate people, loan officers and realtors, to get them to the point where they need to be knowledged of anything upcoming. So I've been in the industry for some time, so I'm also licensed, or certified for the Fair Debt Collection Practices Act, Fair Credit Reporting Act, Fair and Accurate Credit Transaction Act, the Fair Credit Billing Act, many other. There's over 200 consumer protection acts that back us up as consumers. We utilize them to get the results needed to get your client, which would be our client as well, or your borrower, to their much needed goals. So there's, for many years I even did outsourcing services, where we still do that a little bit, but we don't keep it as high as a demand, because there's a lot of bad companies out there and we don't want to work with them. Most credit repair companies are pretty bad, and it's not that they're bad purposely, they just don't even know what they're doing. But let's get past that. So we have over 200 real estate lenders and real estate companies, well over, that use us nationwide. Within those real estate companies and lenders, many loan officers and many realtors, right? So we're a part of the National Association of Credit Service Organization. We're part of the Credit Consultants Association, my favorite and the biggest organization of compliant credit account managers. I'm one of the advisory board members. There's only 12 of us, 11 other, that teach the industry different parts and laws about the Credit Repair Organization Act and many other, and I train the new members in compliance. So in order to get to that level, we're not a fly-by credit repair company. We don't only fix credit. We do a lot of organizational help to help people move forward and get these non-compliant companies out of the industry. We're one of the good ones, and there's many other. They're just not as large, and they don't charge these outrageous fees as we don't. But anyways, let's move forward. So, said that about the advisory board member. There are different certifications. Now, mainly what we're talking about here is FICO10, FICO10T, and VantageScore 4.0. And again, for Fannie Mae and Freddie Mac, right? So this is for immediate release. And I have in the next slideshow here, or next slide, I have the actual media release here that I want to read, and I highlighted a few things. I should have highlighted more, but what's the difference here, and why it's happening, and what the media came out and said here. So here it is. So ultimately, VantageScore 4.0 credit scoring model for use for Fannie Mae and Freddie Mac, the enterprise, right? So they're going to be using this, to see the risk of the borrower, but ultimately regarding the scores and everything else that plays a part in the credit scoring and decision for Fannie and Freddie. This is going to be trained at your loan officer shop, or your broker shop, or as a realtor. These things need to be known, and I should be probably one of the first people ever letting you know about it. So what does it say here? It's a multi-year effort. Well, a multi-year effort, does that mean it's going to be a few years now? No, this started in 2020, just released the information this year, being 2022. We're about to roll into 2023. So can this happen as early as 2023 first quarter? Absolutely. Do we know this? And if we don't, and again, they're going to flip the switch and it's going to just happen. And this is why I'm here. So it's a multi-year effort, deliver both FICO10T and VantageScore 4.0 credit scores with each loan sold to the enterprises. So each deal that is going to go with Fannie, Freddie, has to go this way, and this is what's going to happen. What is it? What's the reason? Improve accuracy of capturing new payment histories for borrowers when available, such as rent, utilities, and telecom payments. So I'm sorry, that's not why they're doing it, but that's what's going to be included. So you're going to see some negativities with this, but you're also going to see some positives. So the positives are what we're going to do to outweigh those negatives that are out of control. So they're going to, and I'm going to get in the next slides, you'll see, but you're going to see that there's things that are going to drop the scores, okay? But you're also going to see here that they're going to be including, and if any, the old school mortgage guys or gals or realtors remember, back in the 90s and the early 2000s, we've always used alternative credit, right? You know, and it would be like rental history. It would be utilities. It would be, you know, things and car insurance and different things that we pay for as consumers, borrowers, that you know, doesn't improve your scores. It doesn't report to the credit bureaus unless you build that alternative credit profile within TransUnion, Equifax, and Experian. So again, it doesn't increase the scores, but on a manual underwrite back in the day, they considered that, and that was a compensating factor. There's really no compensating factors anymore, but I'm trying to go back in time here to educate some that weren't there. Now this will be included into the scoring algorithm. This will increase your scores. So that one of the part of the things that needs to be done, not just by you or we need to do, which we're already putting together this, is getting up to 24 months of their history of their AT&T bills, Sprint, you know, it's State Farm, everything you could possibly think of that we pay for that's not recording to the credit reports or bureaus, unless we default, right? So if we don't pay, you know, a utility, then it hits and it goes to collection. But we want to report the things that are not reporting, telecom payments and things like that. So again, that's going to increase your score. So what does that do? That takes 24 months of payment history, and boom, it gets put into the algorithm and it generates a higher score or adds that into the payment history, which is obviously the highest credit scoring factor. So let's kind of move on here. We've got the, you know, we've got here, and my head's in the way. Let me see if I can move that. But let me see. So what happened in the last slide is the fact that what it is, and let me see if I could actually go back instead of, no. So, so basically what it is where they're going to be including these things into the scoring algorithm, which is extremely important, because this is what's going to outweigh this negative that's going to happen that I'm going to teach you about here. And the main thing here is education. So I've built my foundation and companies based on education, educating people, giving them the real information, not steering anyone the wrong way, being transparent, and teach. But the first thing we all must do is our own research. We can't make decisions based on what others are telling us. We have to do our own research in order to gain the knowledge to teach the right information. So I put in here just a slide that says education, 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 and this is what I'm doing today. I don't get paid for this, right? I don't want to get paid for it. This is something that needs to be put out there, and it needs to be learned by the realtors, loan officers, borrowers, consumers, all alike, because this is going to change their future, which is also going to change yours. So let's kind of move on here. So we have, you know, FICO mortgage scores, all right? So we got FICO2, FICO4, and FICO5 for TransUnion, Experian, TransUnion, and Equifax. Excuse me. So again, I kind of said here, these are the mortgage scores. You go today, run your credit for a mortgage, and let's just say your middle score is a 650. You run your credit same day today, which we obviously advise against. Don't do this, because if you run your credit too many times in the same 44 to 45 day time frame, your scores are going to significantly drop. So I'll get into that. But when it comes down to it, you run your credit today for a mortgage. Let's say it's a 650. You run it today for a credit card and it's a 714. You run it for an automobile and it's a 697. You're like, what is going on? What's my real scores? Well, they use different scoring models for a reason, because each credit scoring model, which there's 16 different FICO scores, they're used by an industry that wants to use that scoring model because that better rates their type of target of clients or borrowers or whatnot. So yeah, moving on. So FICO is the lending scores. Credit Karma, you know, the VantageScore 3.0, Credit Expert scores, all the My Free Score Now, you know, all these different scores we get online, they're fictitious scores. They're not lending scores. They're consumer credit scores and consumer credit reports. No lenders see them. So let's move on here. So we have FICO 2 and 4 mortgage lenders, obviously these are, the FICO versions, and then we have, FICO 5, which is going to be for Equifax. So again, I'm just kind of breaking it down here, no big deal, just trying to get you some information. So let's talk about the highest credit scoring factor. And the reason why I'm getting into this is the current credit scoring models, 2, 4, and 5. This is still going to be used, but again, we're adding in VantageScore 4.0, FICO10 and FICO10T, right? So I need everybody to understand this and grasp how big of a point increase and point decrease and how these things work when it comes to credit scoring. This is very important. This is the foundation of credit right here, what I'm teaching you. A lot of people don't even know this, which is not good. But so the highest credit scoring factor, 35% of what makes up our scores is our payment history. A lot of people seem to think, oh, it's just a late payment, it's just a late payment. No, it's devastating. So it accounts for 192 points per credit bureau. One single late payment could damage your scores that much. If you have an 850 credit score, you'll drop 192 points. But obviously, if you have anywhere between 300 and 850, which is the difference of 550 points, right? So you take 850, you take 300, and the difference, 550. So we want to utilize all those 550 points towards your benefit or the borrower or client's benefit. So let's talk about the payment history. One single 30-day late payment is so damaging to our scores that it takes 9 months to recover from. Yes, 9 months. So what does that exactly mean? That basically means, that doesn't mean that the borrower can't be approved for the home loan for 9 months. Our job is to minimize that 9 months by utilizing other factors in the credit report or the scoring algorithm. But it takes the amount of points you lost from that 30-day late payment or your borrower lost. It's going to take 9 months to recover that amount of points back by doing the same thing that the person's been doing, not being late or whatever, but the positives. It's going to take 9 months. Now, what if a person's 60 days late? It's going to take 18 months to recover from that score loss. Okay, this is FICO talking. This isn't me. 90-day late payment. It's going to take 2 years to recover from that score loss. So it's very damaging. It kills the scores. People get late payments while they're in our program, and we have to work triple hard because then we have to find more positives. Not find, we have to complete more positives, which could negatively impact by being approved for too much credit and whatnot. So again, 35% of what makes up scores, FICO, and is the highest credit scoring factor. So what's next? So we got the second highest credit scoring factor. Typically, when it comes down to the second highest credit scoring factor, this is usually the quickest way to increase the scores if you have some money. So this part could be confusing to some, but 30% of your second highest credit scoring factor of what makes up your scores accounts for 165 points per credit bureau. It's strictly only dedicated to your revolving accounts or credit cards. It has nothing to do with installments. It has nothing to do with anything else. So when you see balances owed, you think, other balances elsewhere. It's only on credit cards, okay? So if somebody doesn't have any credit cards, they're neglecting their whole, they can only get 70%, because 30% of it's not going to be used because you don't have any credit cards or they don't have any credit cards. Having credit cards is one of the most important things about paying on time, keeping low balances. How does this factor work? So again, I'm going to get into the changes of what's going on and why I really have you here, but I also need you to understand this first. But the second highest credit scoring factor, how FICO rates us on credit cards, is just like high school. A through F. So if you have an A obviously being excellent, F being very poor. How do you get that A, B, C, D, and F? It's actually pretty simple once you memorize the percentages, but it's called the debt utilization ratio, keyword ratio. In order to get a ratio in any business or any factors or whatever ratio, you need at least two factors, an A and a B, let's say. So A being balance, B being spending limit. Let's make it easy and say that your client has a $200 spending limit credit card. It's not about the dollar amount. It's about the numbers, right? The ratio, balance compared to spending limit. So that 200 could be 200 million. It's going to be based on the balance compared to that 200 or 200 million or whatever that spending limit is. So A balance of 1 to 9% compared to the spending limit, when that reports to the credit bureaus, you get an A rating, and you're maximizing the scores for that one particular credit card for that 1 month. All right. The issue is if you go one piece of a percentage over 9% or one penny over the 9% dollar amount compared to the spending limit, you're now a B rating and your scores just drop because you're at 10 to 19%. 20 to 29% is a C rating, scores drop more. 30 to 39% is a D rating, 40% or higher is an F rating. So, that being said, balances go up, scores go down. Good news is scores go down. Balances go down, scores go up, right? So, where are most Americans? 40% or higher. Why? Nobody's out there teaching you this stuff. I always let people know that the lower your scores, or if they keep you between a 550 and a 599 credit score, you have to eat out of their hands. But as you get educated and your credit gets better, you're paying them less money. You're paying less interest rate. You have more options. They don't always want that. The more bad of a position you're in, the more money they make. So what we always do is let people know to get their balances down. If they're able to, it's the quickest way to increase the credit scores. What's another way? You got good payment history. You've had the credit card for 8, 9, 12, 18, 20, 24 months. You've never had a credit limit increase. Get that credit increased or that limit increased, and now you just reversed it. You might be an F rating, but now as you get that credit increase, you're now a C rating and increase 50, 60 points. Paying a credit card balance or multiple credit card balances down from an F to an A rating usually increases you 40 to 80 points. I've seen 140 points increase per credit bureau in between by paying credit card balances down. It's a huge weight on borrowers and all of our credit scores. If you have high balances or 40% or higher, then what's going to happen is when you make that on-time payment elsewhere on your car loan or your mortgage, you might be getting 3, 4 points, even 1, 2 points. But if you have low balances on your credit cards, you make that same on-time payment, you're getting 5, 7, 9, 10, 11 points for that same on-time payment. Why? Because you're also showing A ratings and good payment history and low balances elsewhere on your credit. So all this stuff plays a part with other credit scoring factor. We show the top 5 because that's the pie graph you see, right? But there's many, hundreds of other scoring factors. Okay, so now let's quickly, because this is important, of course, but it's not as important. So age actually is important because age is 82% of what makes up our credit scores, or 82 points of what makes up our credit scores. So you never want to challenge the first credit card, the first automobile, or first installment, the first student loan, the first mortgage. You never want to, because that stays on your credit. It's going to show there for years. If you delete your first or oldest type of account, then your scores will drop up to 82 points. It's typically 50 points, 30 to 50 points, right? And this is where a lot of credit repair organizations or so-called credit repair companies mess up. So what they do is they're challenging everything negative. You never do that, because then if they don't answer, when I say they, the creditor, because of one single late payment, they're actually devastating the scores. And guess what? You cannot reverse that. You can't call up, Washington Mutual from years ago and have them put it back on. It just doesn't happen, because they're closed down. But, again, ultimately, any company, they cannot reopen the account. So next, we have, the new credit is 55 points. It's important to understand that when we add credit accounts or get people approved for credit accounts, or trade lines, legal trade lines, they can increase up to 55 points. They could also increase up to 30 points if it's a credit card or first credit card, and then they can increase up to another 30% by, not 30 points, 30% by making a small transaction and keeping a small payment. So there's all these different things that we could do to increase the scores pretty quickly. So that's new credit. Lastly is a mix of credit. Mix of credit's important that if you have a client only paying credit cards, we need to get them an installment, him or her an installment, because what this is going to do is it's going to increase the scores when they make on-time payments and increase the scores when they have different types of credit reporting. So what I mean by that is they have credit cards, you put a self-lender account, which will cost them $5 or $10 a month. And in most cases, some of them you get the money back after 12 months of payment history. They have like a $5 fee, right? But what I'm getting at is when you're only making payments for installments and you put a credit card in there, you get up to 10% score increase because now you have different types of credit. You're not only paying on an installment, but you're also paying on a credit card. Oh, now you just got a mortgage. Up, you get another mix of credit. A home equity line of credit, another mix of credit. So you get all these different mix of credits by the different types of credit you have. So that's important to understand. So, next what we want to talk about is really VantageScore. So we spoke about just now about how FICO works and the major scoring factors. VantageScore is really, VantageScore 4.0 is really the trended data. So it's trended data. This right here is going to be statistics. So what they took some, while nobody knew, in 2020, they started running this system through random consumers' credit reports, different variables of different types of credit profiles. So they did it with credit limits, amounts due, actual payments. They went back to 2016, did this in 2020, but the 2016 levels, and so the bank cards, mortgages, installments, and autos. These are all different types of accounts, and they were basically. And I put this slide in here to let you know that they went back to 2016 and even behavior from 2014 and 16 and getting all this data to be able to make this software go based off of past trended data. So they're taking all this data from the past and they already have it in the system and they're running samples and different variables on them. So it's ready. They're ready to pull the trigger, and it's kind of scary. But let's go on to the next slide here. So the additional considerations. So what's going on is not just the fact of credit cards, the trended data, the changes with everything that's happening. And I'll give an example. Let's say that you have a client who has, and I just taught you the second highest credit scoring factor. Okay. This is all the same with the mortgage scores, but they're adding in what I'm teaching you or about to teach you is that this trended data is huge, and I'll let you know why. So when you pay down a credit card or your borrower pays down a credit card, and let's use the scenario of $1,000 spending limit credit card. They're an F rating, right? That just means that they have a $400 balance because 40% or higher is an F. So today, what you could do is pay that credit card balance down to a D rating, a C rating, a B rating. Best place to get it is 1 to 9%, which is that A rating. So that 1 to 9% of a $1,000 spending limit is $10 to $90. So let's just say that they pay it down to $89. Now they're in an A rating. That's going to increase the scores. It's typically going to increase 20 to 120, 140 points per credit bureau by paying, roughly $400 down, or really like $310, right? So that's going to increase their scores, usually enough to be approved for a home loan if there's not a bunch of derogatory. And obviously there's other factors, so I can't say that for sure. But that's what's going to still happen with FICO 2, 4, and 5, the mortgage scores, but it is not going to happen with VantageScore, FICO10, and FICO10T. So what's changing is they're not going to see that large score increase, roughly really anything, maybe 1, 2, 3, 4, 5 points for making that adjustment on their balance. So that's a huge negative towards the mortgage industry, because part of our steps and other companies' steps and what we let the loan officers and realtors know, not really the realtors, but more the loan officers know, because they're on the finance side, where we tell the borrower they have to get this balance down from $400 down to $300, or down to a $90 balance, or between 10 and 90, to increase the scores. We're still going to work and do that. We always give the client steps, kind of homework or stuff they have to do, or work towards, but it's not going to do anything for VantageScore 4.0, FICO10, and FICO10T. That's just not going to happen. It's not going to increase the scores. We're still going to have them do this. But we have to look at, well, if that's not going to work, what will? And in the beginning of this video, or this presentation, I did mention that there's positives that we have to inject into the credit to increase the scores, and take away from this negativity. So it's actually a good thing when it comes down to. So my job is to not get that score decrease of 20% or 20 points or higher from when they flip this switch, but it's to try to increase it 40, 60, 80, 100 points or more when they flip this switch. And the way to do that is by getting the people now, and basically to help them understand that, hey, we need their payment history, and we're going to teach them how to get it. It's very simple, and then we get that over the credit bureaus. So let's get into the additional consideration. Okay, collection accounts, paid versus unpaid collection accounts. Okay, all paid collection accounts, medical and non-medical, are ignored in VantageScore 4.0. So paid collections. So we know as credit specialists, and as well as you probably know, as a loan officer or a realtor, you pay off a collection today, your scores are going to drop. More than 90% of the time, they're going to drop. Why are they going to drop? Well, let's say in the Illinois, statute of limitations is 7 years. Now it varies state by state, but let's base it off of Illinois. Wisconsin is 6 years. 10 years in California. You got all these different statute of limitations for a type of account. But let me explain why your scores drop, or anybody's scores drop. Is because when you have the statute of limitations of X amount of years, anytime during that X amount of years you make a payment, it restarts the date of last activity, which starts the statute of limitations. The date of last activity is what starts the statute of limitations on a collection account. So you extend the statute of limitations by the full amount, depending on that state, which drops your scores. So you've got people making payments every month on a collection, it's dropping their scores because it's restarting the statute of limitations every single time they make a payment. So now you make a payment, VantageScore 4.0, the scores are going to increase ultimately because they're deleting it. They're deleting it once you get paid. So it's now we got medical versus non-medical unpaid collections. Unpaid medical collections accounts are penalized less significantly than unpaid or non-medical collection accounts. So when you have a medical account or collection, you're not going to be hit as hard of points as you are on FICO. So all this is important because it changes and adds more. A lot of times as a realtor, you don't really need to worry about this stuff. I know it's very important, to get the client pre-approved, and so it's worth your time. But this is kind of when it comes down to the loan officer is going to look at this credit report and say, oh man, there's been so many changes. Just get it over to us. We're going to get the free credit analysis completed and get this stuff done. So medical versus non-medical, right? So the medical collections are no longer going to, it's going to still, unpaid medical are still going to hurt your credit when it comes to VantageScore 4.0. But it's not going to be as bad as a non-medical, right? A Sprint, whatever it may be, a utility, anything. So medical collection accounts that are less than 180 days old are not considered, okay? So they're not even going to be considered in the scores. For medical debts. There was a law that recently passed where it could, 180 days that they have to work, not 180 days, 12 months they have to work, the medical department, to collect that debt before they could even submit it to the credit report. So a lot of these collections you're going to see are going to be older. A lot of these medical collections, we could get deleted instead of paying them. So that's some good information there about the medical and really the collections in general. So The handling of inquiries. So this is important to understand. So I'm going to kind of read it here because this is new to me for the most part that I was going through. All this is new to me. I've been researching it for weeks and weeks just to make sure that I have all the knowledge and information I needed before getting this information out. So multiple major credit inquiries within a 14-day window are considered one inquiry regardless of the type of account, like a mortgage, auto installment, or bank card. Retail, collection, and utility inquiries are not deduped, which means not duplicated. So right now, or with FICO, how it works is you, if it's a mortgage, you could run your credit today and you're going to get hit with an inquiry, right? Because it's a mortgage inquiry. You run it, then after today, you have 44 more days to run your credit, unlimited amount of times, FICO says, and you will not get an inquiry. Why? Well, they know that you're shopping for a mortgage. It's a large purchase. It's considered a large purchase, just like an automobile too, but obviously a home is a larger purchase. So you could run your credit, you could shop around, you might not like the loan officer's tone of voice, hair, or whatever you want. You just have a reason, or you don't like their program or interest rate, or currently want to wait a little time and have some options and viewing some homes and different. Now, after that 45th day, you're going to get hit with another inquiry. Now, the issue is if you run your credit for anything else, credit card, an automobile, your scores are devastated due to that because now you're trying to be approved for different types of credit in a short amount of time. You're trying to be approved for a home, you're trying to get a car, you're trying to get credit cards, all these things FICO considers at a high risk. So do we. You're trying to be approved for too much in a short amount of time. Stick with just getting a mortgage. We understand things happen. But anyway, so multiple major credit inquiries is a 14-day window now are considered one inquiry regardless of the type. So that's questionable. Is the 45-day or 44-day time mark in there? It says there 14 days, so you could get different types of inquiries in a 14-day window considered one inquiry, regardless of the type. So that's good information there. That will actually help. Natural disasters. This is going to be a big one for credit repair companies. We're going to see a lot of excuse my language, but bullshit when it comes to them saying, oh, everything is a natural disaster, right? So they're going to have to limit this, or they're going to have to change something, meaning VantageScore 4.0 or VantageScore in general about, because you're going to have every credit repair company coming out the woodwork saying, oh, this was a natural disaster. So it's, if the lender or servicer places a natural disaster notification on the account, delinquencies are temporarily excluded from the calculation of the consumer's credit scores. Well, now they're going to take every account, just like how they did in the 90s and disputed everything to get everything pulled out of the credit scoring algorithm. Then they'd run the credit report. Brokers did that. It wasn't credit repair companies. It was brokers who did that. And everybody, credit repair companies got the bad rap for it. But they're going to do the same thing here. So they're going to say everything is a natural disaster. So it's going to pull that negative account or the negativities of that account out of the calculation of the scores, and their scores are going to be higher, right? So it's a good thing. You've got all these different hurricanes, we have different tornadoes, you've got these freezes that just happened, all this stuff going on. These are natural disasters, and you deserve, and we all deserve, that if there's a problem, we deserve for that negativity to be taken out of the credit scores temporarily while there's an investigation or whatever, or removed because of something that was out of our control, right? So this is a big one. Again, credit repair organizations are going to take advantage of this, as well as loan officers and brokers. I see you guys coming. Handling of student loans. So government and private student loan information are considered in combination. This is huge too. Everybody sees that as a loan officer in underwriting, you've got to take half of a percentage of the balance. It used to be 1%. It could have been more. I don't know. But in multiple, you would see different loans every quarter of a school year. So typically, when you have a federally backed student loan, what you're doing is getting a minimum of 4 different accounts per quarter, right? Because the school needs to be paid every quarter, and the federally backed, Navi and different places, Department of Ed are supplying this money. to the school every quarter. So now it's considered as one. Deferred, active, and pay down status. So this is a big thing too, which is going to help with the credit scores, also managing different things and getting approvals. So these are additional considerations. Now remember that the major is going to be the trended data, right? So the trended data is what is really going to be the negativity towards getting people approved for home loans, because now, do we know what Fannie and Freddie minimum for VantageScore 4.0 and for FICO10T is going to be? No, because they're only going to use two of the tri-merge, now bi-merge with TransUnion, Equifax, and Experian. So it's really only using 2 credit bureaus. It's no longer going to be 3. From my understanding of what I'm being told is it's going to actually be 2 chosen ones. So what are you going to do? You're going to take the one with less negativity, the 2 that are higher credit scores, right? So we're going to see some things changing. We're still learning too, right? I've been doing this for a long time, and always staying with the Consumer Data Information Association and different organizations to stay on top and get this information out as soon as I can. But it's important to understand that there's some things that we're still learning about. Okay. So next slide is. I'm sorry, authorized users. The impact of boosting the credit scores is not going to be as much. I'm sorry, I forgot about this. The impact of score boosting through rental authorized user trades is minimized. So let me tell you a little bit about this. We used to be able to, before 07 and 08, used to be able to put people on as an authorized user. Why did they stop doing this? For a period of time, they stopped doing this because it was abused. So how was it abused? Well, people are selling authorized user accounts. You buy one in California, you don't know who this person is. You get a $5,000 spending limit, 5-year history, and it would boost your credit scores up a lot. Well, that's mortgage fraud. If you give that type of account for the purpose of being approved for a mortgage, it's considered mortgage fraud. I don't know how easy that is to detect, but that's mortgage fraud. People go to jail for it. For selling the trade lines anyways, illegal trade lines. So in 2007, they pulled authorized users directly out of the algorithm of the credit scoring. So that's why, but also because if you took, let's say, a dad and a son, Big John and Little John. Big John's had a credit card for 20 years. Little John is 18 years old, never had a job, just graduated high school, not looking to go to college, whatever the case may be. Doesn't matter, but doesn't qualify for a home loan. Big John puts Little John on as an authorized user, right? Soon as Big John makes one payment to his credit card balance, let's say that they had that credit card for just say 10 years to keep round numbers. Now Little John's credit scores just went up to a 784, 802, 760. Bottom line is they've got prime credit. Well, back in the day, you used to do the no income, no asset, no employment verification, right? Based on just a credit score. So you didn't have to show income, assets, employment. You didn't have to really show anything because you had a heartbeat and you had a good credit score. Well, they caught on to that pretty quickly. They let it slide for some years, but they cut it out in 07 or 08. And that was because so much fraud that was going on, but also because it just wasn't right. Little John doesn't have a credit score or a job or anything, and all of a sudden goes on Big John's, and now they've got excellent credit. Now, was that a niche? Was that something that worked for the realtors and loan officers? Absolutely. But then it also screwed up the economy big time because you had so many people that were approved for home loans that should not have been approved for home loans. So authorized user accounts are no longer going to be an impact on the credit scores. So this is also something that changed in FICO, but this is, we're talking about VantageScore 4.0. It's going to be very minimal. You're not going to see much of a score increase by adding. Now, if it's 1 point, we all know that 1 point is important. So you want to look at authorized user accounts, and you want to make a decision based on many different factors. Low balances. Remember that A through F rating. You want to make sure that there's no late payments ever, not just the last 2 years, ever on that account. It's always been a good account. Then, low balance, it's typically a good account to get on. You will lose more points than gain points when it comes to authorized user accounts. Okay, just keep that in mind. And the reason being is as soon as your dad, brother, whoever the actual individual owner of that account is, increases that balance and goes over, goes from an A to a B, B to a C, C to a D, D to an F, so forth, they're going to devastate the scores, because that part is still included into the algorithm. It's not going to help as much when it comes to the positives of an authorized user account. Okay, so moving on. Trended data. So when the credit files in development samples were evaluated at the performance date, each trade line was classified as either good or bad for VantageScore, and classification was defined as follows. So basically what they're doing is they're going back on an observation date, let's say 24 months, and the performance doesn't happen on that performance date. You don't get the points until that performance date. So what do I mean by that? You have that same scenario. You have that credit card of $1,000 spending limit, a balance of 400, F rating, right? You pay down that balance to a $10 to $90 balance, which is that A rating, 1 to 9%, right? Just follow me, F to an A. And normally, right now, let's just say for the sake of this video, you increase 50 points. VantageScore 4.0 are not going to give you that 50 points until the performance date, roughly 24 months later. So it says that you could gradually start going up from six months. Might get a little 1-2 point score increase when you make that payment down, go from an F to an A, but you won't get the full amount of points, that 50 points, until the performance date. So the performance date, it could be 6 months out. It could go all the way up to 24 months. So again, you're not going to significantly increase the scores in a short amount of time, days or up to a month. And that's because their performance date is going to be 24 months out. So again, will this help with credit card? Will this help with FICO 2, 4, and 5? The original mortgage scoring softwares? Absolutely, it's still going to, unless they change that. I don't think they would. Why would they? They would have just changed that and not included VantageScore 4.0 and included 10 and 10T. They're adding into it because of trended data and performances they want to rate later on down the road after you. Now, why are they doing that? Well, I know of a loan officer that started a business, and she basically, this is a perfect example, she always kept very low balances, $5, $10, $20, sometimes zero constantly, and would make a transaction just so it doesn't, so there's activity so they don't close it. She's very good with her credit. And she decided to start a business, well, in the real estate industry, but with marketing and things like that. And she had to use her credit cards, and she had to use a significant balance compared to the spending limit on multiple credit cards. She dropped over 100 points per credit bureau. So now she's not a good credit borrower because that 1 month or 3-month time frame, she had to max out her credit cards or use her credit cards. If anybody goes through that, they shouldn't be hit for that. They've been keeping a low balance for well over 24 months. And they're going to get hit for 100 plus points per credit bureau because they've made a life-changing decision to better their future, better the future of borrowers and people out there, clients and whatnot. That shouldn't happen. So that's not going to happen in these models, VantageScore 4.0 and 10 and 10T. Now, if you got somebody who always has an $800 balance and 80% to 40% or higher and always a C rating or whatever, then unfortunately it's not going to be a good model for them. If you keep low balances and typically use the credit as needed, then it's going to take the 24 months on all consumer credit reports. The data, it's going to take the 24 months and it's going to average what the actual balance is. So if you got somebody who's got an 800 to a 600 balance on a $1,000 spending limit over the course of the last 24 months, if they're roughly between $600 and $800, a lot of times the average is going to be 700. So they're not really doing too well. But if you take somebody like that loan officer and other people that I know, as well as many people you may know or you yourself, this is a good model for you. So take the good with the bad. And it's nothing we could change, but we do have to educate and know what's going on here so we're able to use this towards our advantage and towards our borrowers' advantage. So this dependent variable trended credit data is kind of just what I spoke about, just broken up here in different language. So let's move on. So VantageScore and FICO. So it's not Vantage versus FICO, like it used to be. It's really Vantage and FICO teaming up together to create a better statistics of less people being, having a high risk closing on, on a mortgage or seeing that the risk and default statistics. But we've got the payment history, and then we've got payment history on FICO. We've got the utilization versus length of credit, balance versus amounts owed. So it's just showing here just a breakdown of the difference between, right? So I spoke to about the 35%, the highest credit scoring factor, the second highest 30% of FICO, the 165 points, the 192 points, 55 points, 82 points, etc. That's FICO. That's still in effect. But the new Vantage score is different. We're looking at 32 instead of 35, 23 instead of 15, 15 instead of 30. So all this stuff is going to change and it's going to be added in. Any of this information you need help with, I want you to reach out to me directly or any of my associates to be able to get information. We're building a database. We're building a lot of information in our system to be able to get out there. I had to hire somebody to do the online marketing. We also got a program going together. We're 50% off of our services based on a membership with us for realtors and loan officers, where we're also going to build their personal credit at no cost in some sense, but that's going to be included in the fee. We're also adding geofencing, search engine optimization for your homes, have listed as realtors. We're going to have beacons in the homes, so when anybody drives by within a certain radius, they're going to get a text message letting them know about information about that home and a link. So there's a lot of different things we're putting together to better not just business and your future business and getting you more clients, but we're also putting together a lot of stuff to be able to educate everybody, including seminars we're being requested to as guest speakers to speak to your borrowers and possible prospects. So it's a very important to understand that we're going to be here involved with your activity to be able to get more clients for you. So that's that with Vantage and FICO. So let's get some notes here. So we've got VantageScore. This is for 4.0, but a lot of it is VantageScore in general, but this is strictly 4.0. This is the newest scoring model. Ignores all paid collections. Your scores are not going to drop. Your borrower scores are not going to drop, right? For any paid collections, or they will increase on VantageScore 4.0 if they make a payment towards it. The downside is what's going to happen with your FICO scores. 2, 4, and 5, which they only need a buy merge now, are going to decrease because you made those payments. So we're now looking at kind of a dimensional situation here where we got to look at this score, and take the loss here, or do we not take the loss here and see if DU will accept it. So there's a lot of different things going on here. So next. Lesser penalty for unpaid medical collection. Scores do not decrease as much. Medical collection accounts that are less than 180 days are not considered. We went through this stuff. This is notes. Take a screenshot. Keep it. This is being recorded. I'm going to get it out to people and everybody if they request it. Significant performance lift over VantageScore 3.0. Who cares about VantageScore 3.0 in the mortgage industry? We all laughed about VantageScore. We all said that VantageScore would never be in the lending industry. It now is. We were right, half right? So half right is that it's not 3.0 we're going to be using. It's 4.0, but we're still going to be using VantageScore. So there's even more people that use VantageScore than FICO, actually, statistically speaking. So most, especially in the mortgage and banking credit card originations, improves the ability to recognize risk possibilities in the mortgage and credit card originations, new files. So what does the mortgage industry want to do? They want to lower the risk. That's why there's underwriting. That's why there's DU. That's why there's LP. That's why there's all these things going on, including our jobs, right? So multiple major credit inquiries within a 14-day window are considered one inquiry regardless of the type of account. We went over that. If the lender or servicer places a natural disaster notification on the account, delinquencies are temporarily excluded from the calculation of the consumer credit scores. How long will that be for, that temporarily excluded? What's time for? We don't know yet. You know, that'll come as things change and this gets introduced to the public, which I'm trying to do now, and keep this going. So government and private student loan information are considered in combination. You know, this isn't going to be a multiple hit. So let's take somebody who has an account that is deferred, coming out of deferment, right? And they moved, they don't get that letter that says, hey, it's coming out of deferment, they get a late payment. It's going to be one late payment. It's not going to be 16 different late payments because they spent 4 years times four semesters. You know, it's going to be one late payment. It's going to be all in combination with each other. So I hope that you understand that. If not, just let me know. Scores approximately 40 million more consumers than conventional credit scoring models, meaning many will have scores that do not or did not, right? So we will see a lot that when we delete everything on a credit profile except for something really old like a credit card, first credit card or something that we're not going to challenge, that on FICO 2, 4, and 5 they will have no scores. Well, that's because there's no consistent payments or 6 consecutive payments, payment history, to generate a score within the last 6 months. So 6 for the last 6 months. VantageScore 4.0, or sorry, 3.0 will show it. And it looks like VantageScore 4.0 is going to show a balance or a credit score as well. So that's good news. Generating more consistent scores across the 3 national credit reporting companies, 3 major credit, TransUnion, Equifax, and Experian, allowing lenders to have confidence in default probabilities regardless of what credit reporting companies calculate the scores. So if FICO 2, 4, and 5 don't have scores, they're going to have to go based off of the VantageScore. So, Fannie and Freddie might say, hey, we'll take 0 scores, but you have to have at least a 610 or 600 or 620 or 690, whatever it may be, on the VantageScore. So there's going to be some changes, and there's going to be some manipulation, different things going on here that we just don't know about yet. Why the change? Lender confidence in all areas. That's the bottom line, right? Estimating 20+ point decrease from past FICO models. So let's go to FICO10 and 10T. This one is not long. This is the ending part of this presentation, just so everybody knows. It's the newest FICO credit scoring model, consists of 2 scores, FICO10 and FICO10T. Remember, 2, 4, and 5 are going to be used. You could pick 2, or are they talking about just FICO10 and 10T? Will 2, 4, and 5 be out? We don't know yet, so that could be a possibility too. So FICO10T credit scores includes trended data. We spoke about that, which looks at individual consumers' payments, debt histories for the previous 24 plus months to help calculate their credit scores. So this is a big part. It's not really what's going on today, which will be which will be performance data 24 months out. So if you do something today, you're just not being scored on it for 24 months or up to 24 months. This score is going based off of what your scores were like, or what your defaults or your positivities that were going on 24 months ago. So it's important to understand that this is really your today's score 2 years ago. Pretty crazy when you think about it. Will not replace the other scoring models, right? So that just answered the question, which I threw out there purposely, but there could be changes. We don't know, but it's not replacing it. They specifically said in the news release is that they're not going to. But again, anything could change. Could reduce mortgage defaults by 17%. Some are saying higher. A good percentage is 17%, which that number you got to look at in many different ways. Your office is going to close 17% less, at least 17% less, right? Your loan officer is going to, you as a loan officer, you as a realtor, you're going to close 17%. This is what we don't want to hear for 2023. But if you follow me and listen, we'll get that 17% in the positive side, not the negative side. We'll get the 30% more or less, depending on how many clients you get to where we're going to be able to do a lot of free services for them and get their their past 24 months included to the credit bureaus. Get these scores or these accounts generated for the last 24 months to get those new scores or that added into the calculation. This will include payment history for borrowers when available, such as rent, utilities, and telecom payments. That's what they break it down. They say rent, utilities, and telecom payments. There's going to be more. So there's going to be insurance payments, different things that are included. So we're going to basically ask for everything. We're not going to submit anything negative. You know, if we've got someone who's got an AT&T bill and 3 months ago they were late or whatever it is, well, we're not going to consider that because that late payment's going to drop them down, right? It's the highest credit scoring factor when it comes to FICO. So we don't want to use that. We'll have to use another account that they've been paying 24 months of on-time payment history. So this is going to be something that we have to look at in detail and submit the right stuff. Enterprises will require lenders to provide credit reports from 2 of the 3 nations' credit reporting agencies, not all 3. We spoke about that. Buy merge, no longer try merge when this is rolled out. Okay, late payments will hurt credit scores even more under the FICO10 and FICO10T models, more significant than the previous FICO models. What do we talk about? Highest credit scoring factor. 130-day late payment takes 9 months to recover from. 60-day non-payment takes 18 months to recover from. And a 90-day non-payment takes 2 years to recover from. It's more. So FICO10 and FICO10T, it's more. Remember what I just taught you in the beginning here. What is factual information? FICO2, 4, and 5. Now FICO10 and 10T. It's going to hurt even more. Okay. Credit utilization will also carry more weight with the new credit scores. Decreased more scores more than previous models. Right. So same thing with the balances. That second highest credit scoring factor, A through F rating. Could drop you down up to 165 points, A, B, C, D, F, F, D, balance up, scores down. It's going to be even more points. It's no longer 165. It's probably going to be 180. Who knows? And you'll have less point increases for mix of credit, and you'll have less point increases for new credit, and you'll have less, point increases for age of credit. So we'll see. Estimating a 20+ point decrease from previous FICO models. So if you're looking at a 660 right now on your credit scores, you're probably at a 640 or less. It's estimated. Or you could be plus, right? You could be that loan officer that I was talking about that kept their balances at $0 to $10 to $20 for the last 5 years and had to use the credit to get more business and generate a better future for her and her children, and your scores are going to be now to 775 or whatever, 780, whatever it may be, because you made really good decisions in the last 2 years or more with low balances, not realizing this is going to happen, and you are rewarded as you should be, right? So that's it. So I hope this information helped. I wanted to make sure to get this information out to everybody. This is recorded. It looks like I roughly took an hour and 2 minutes so far to get this done. So I wanted to make sure to, get everything over to you so you're more knowledgeable in the changes of what's going to happen. Reach out to us anytime, okay? So I wanted to make sure to, I've got some disadvantages and advantage here. Which this is all good information, but I already let you know about the alternative credit create, so here's some information if you want to contact me, but the information on the last slide is more based on, stuff we already talked about. I probably shouldn't even have included in there. But if you want to reach out directly to me, email me. My cell phone, there's 2 numbers there, it goes to the same phone. They're for different locations. But please text message, email me, call me, Facebook message me. Facebook is probably the last place you want to, because my last Facebook was hacked, and I went from 4,200 people that I had on there. A lot of people I taught, companies, credit repair organizations, down to about 400 people now. So do me a favor, reach out to me in other means. I appreciate it. Craig Rice, Credit Craig, Patriots Credit Services. Thank you.